As the final quarter of 2014 kicks into full swing, now is the perfect time for taxpayers to start thinking about year-end tax planning. Fortunately, most of the tax rules remain unchanged for 2014. However, uncertainty over a few expired or expiring tax revisions complicates the planning process. Here are a few ways you can develop some strategies to reduce your taxes. Individuals can often reduce their tax bills by deferring income and accelerating deductions. One great way to defer income is by asking your employer to wait to pay your year-end bonus until after the year officially ends. When it comes to accelerating deductions, you might choose to pay certain property taxes early. You might also consider increasing your IRA or qualified retirement plan contributions to the extent that they'll be deductible. Such contributions also provide some planning flexibility because you can make 2014 contributions to IRAs and certain other retirement plans after year-end. Remember that when you use a credit card to pay expenses or make charitable contributions this year, you can deduct those expenditures on your 2014 tax return, even if you don't pay the bill until next year. If you've sold stocks or other investments at a gain this year, or plan to do so, you should be looking for opportunities to offset those gains by selling some of your poorly performing investments at a loss. Reducing capital gains is important if you are subject to the net investment income tax, which is a 3.8% Medicare surtax imposed on the lesser of either a higher income individual's net investment income or the amount of modified adjusted gross income, or MAGI, that exceeds a specified threshold. In addition to reducing your net investment income by generating capital losses, you may also have opportunities to bring your MAGI below the threshold by deferring income or accelerating deductions. If you plan to make charitable contributions, consider donating highly appreciated stock or other assets rather than cash. This strategy is particularly effective if you own appreciated stock and you'd like to sell it but don't have any losses to offset the gains. Donating stocks to charity allows you to dispose of the stock without triggering capital gains taxes while still claiming a charitable deduction. You can then take the cash you plan on donating and reinvest it in other securities. If you plan to make annual gift transfers to individuals or trusts, it's a great idea to make these gifts before year-end. This strategy will reduce the value of your estate without incurring any federal gift tax. For 2014, the annual exclusion amount is $14,000 per recipient, or $28,000 for married couples. It's possible that certain expired tax breaks may be extended before year-end. If so, you may be able to benefit from some last-minute planning opportunities that may arise. Some expired tax revisions to keep an eye on include tax-free IRA distributions to charity for taxpayers aged 70 and a half and older, the deduction for state and local sales taxes, the above-the-line deduction for qualified tuition and related expenses, and the credit for energy-efficient appliances. Be sure to review a list of expired tax provisions that appears at the end of this video to see if any apply to you. Most strategies for reducing your 2014 tax bill have to be implemented by the end of 2014, so it's a good idea to start planning now. But remember, uncertainty surrounding the fate of a few expired tax breaks can complicate matters, so contact your Untracht early tax advisor to learn about these strategies and dealing with whatever legislation is signed into law. I'm Marlon Dunbar with Untracht Early.